Curious about the top 10 stocks to invest in for 2025? You're in the right place. Welcome to our deep dive into the world of investment. We're about to embark on an exploration of the top 10 companies that are poised to dominate the market in 2025, from the innovation powerhouse of Apple to the tech titan Google, the e-commerce giant Amazon to the software behemoth Microsoft. We've got them all covered. We'll also shed light on the social media monolith Meta platforms, the electric vehicle pioneer Tesla, and the promising Chinese electric vehicle manufacturer NIO. We're not forgetting the data analytics innovator Palantir Technologies, the semiconductor giant Advanced Micro Devices, and the graphics processing unit leader NVIDIA. We'll examine their competitive advantages, revenue trends, price history, net income growth, profit margins, debt-to-equity ratios, and price-to-earnings ratios. Stay tuned as we delve into each of these stocks and why they are worth your attention. Starting our list with Apple, a tech titan that needs no introduction. Apple's competitive edge lies in its strong brand image and innovative product line, from iPhones to MacBooks, which command a premium in the global market. The revenue trend for Apple has been on an upward trajectory over the years, reflecting steady growth. The price history of Apple's stock also indicates a positive trend, with minor fluctuations. The net income growth has remained consistent year over year, a testament to Apple's strong business model and pricing strategy. The company's profit margin remains robust, underlining its cost-effective operations and high-value products. Apple's debt-to-equity ratio is well managed, ensuring financial stability and resilience. The price-to-earnings ratio, while relatively high, is justified by the company's steady earnings and growth potential. Apple's innovation and consistent growth make it a compelling choice for investors. Next up, Alphabet, the behemoth behind Google. This tech titan's competitive advantage lies in its vast network of services, from search engines to cloud computing. It's a jack of all trades with a firm grip on digital advertising, ensuring a steady flow of revenue that has seen consistent growth over the years. Taking a look at its price history, Alphabet stock has been on an upward trajectory, reflecting its strong financial performance. Year after year, net income growth is visible thanks to the company's ability to monetize its diverse services. And let's not forget about Alphabet's impressive profit margin, an indicator of its operational efficiency and pricing strategy. In terms of debt, Alphabet maintains a low debt-to-equity ratio, demonstrating its financial stability. The company's price-to-earnings ratio is also worth noting. Although it might seem high compared to other stocks, it's a testament to investors' high expectations for Alphabet's future earnings. With its dominance in the digital advertising space, Alphabet is a stock to watch. Now let's discuss Amazon, the online retail giant that has expanded into cloud computing and more. Amazon's competitive advantage lies in its vast selection and fast delivery, fueled by a sophisticated logistics network. In terms of revenue trends, Amazon has consistently shown growth, with a notable uptick in 2020 and 2021 due to the surge in online shopping. The company's price history reflects this upward trajectory, with stock prices soaring in parallel to its expanding market share. Amazon's net income has also been on the rise, with significant year-on-year growth. The company's profit margin, while not the highest in the industry, is solid and has shown consistent improvement. A glance at Amazon's debt-to-equity ratio shows a prudent approach to leveraging, with a lower ratio indicating less reliance on debt. The price-to-earnings ratio, while high compared to some competitors, reflects investor confidence in Amazon's continued growth potential. Despite its size, Amazon continues to grow, making it a potential investment. Let's move on to Microsoft, a leading player in the software industry. Microsoft's competitive advantage lies in its diverse product portfolio, including the ubiquitous Windows operating system, Office suite, and cloud services like Azure. This diversity allows Microsoft to generate consistent revenues, with a steady growth trend over the past decade. Looking at the price history, Microsoft's stock has maintained an upward trajectory, indicating a strong market confidence. The company's net income growth has also been impressive, reflecting its excellent operational efficiency. Microsoft's profit margin is commendable, demonstrating its ability to convert sales into actual profits. The company's debt-to-equity ratio is relatively low, suggesting a sound financial structure. Lastly, Microsoft's price-to-earnings ratio might seem high, but it's justified by the company's consistent growth and strong future prospects. All these factors combined indicate that Microsoft is not just a market leader, but also a reliable choice for investors. Microsoft's diverse product portfolio and strong financials make it a solid investment. Next, we have Meta, previously known as Facebook. Meta's competitive edge lies in its ecosystem of apps like Instagram, WhatsApp, and Facebook, which collectively boast billions of users worldwide. This vast user base allows for significant ad revenue, which has seen a steady upward trend over the recent years. The stock price has had its ups and downs, reflecting the company's challenges and triumphs. Yet net income growth has generally been on the rise, showcasing Meta's ability to turn sales into profits. Speaking of profits, the profit margin has remained healthy despite the costs associated with the company's ambitious metaverse initiative. Meta's debt-to-equity ratio is somewhat higher compared to other tech giants, a result of their aggressive investment strategy. However, the price-to-earnings ratio suggests that the market has confidence in Meta's future profitability. With its shift towards the metaverse, Meta is a stock with potential for future growth. Now let's talk about Tesla, leading the charge in electric vehicles. Tesla's competitive advantage lies in its unique blend of technology and automotive expertise. This has allowed Tesla to pioneer the electric vehicle industry, creating a high barrier to entry for competitors. Looking at Tesla's revenue trends, we see a consistent upward trajectory over the past few years. This growth in revenue is mirrored in the company's stock price, which has seen an impressive rally. Net income growth, too, has been on the rise, indicating the company's increasing profitability. Tesla's profit margin, while it fluctuates, demonstrates the company's ability to turn a profit despite the high costs associated with the electric vehicle market. Its debt-to-equity ratio, a measure of financial leverage, is relatively low, suggesting a healthy financial structure. The price-to-earnings ratio, while high compared to traditional auto manufacturers, reflects the market's optimistic outlook for Tesla's future earnings potential. Tesla's innovative approach and market leadership make it an intriguing investment. Next, we have NIO, a promising player in the electric vehicle market. This Chinese company has been making waves with its premium EVs, boasting a competitive advantage with its battery swapping technology. This unique feature provides NIO vehicles with a longer lifespan and offers customers flexibility and convenience. Over the past few years, NIO has shown impressive revenue trends with consistent year-over-year growth. This upward trajectory is mirrored in its stock price history, with the company's shares showing a steady climb. The company's net income growth has also been commendable, demonstrating a promising profit margin. While NIO has incurred some debt, its debt-to-equity ratio remains within acceptable levels, indicating a healthy financial state. NIO's price-to-earnings ratio, though on the higher side, reflects investor confidence in the company's future growth potential. This, combined with its innovative approach to the EV market, makes NIO an intriguing prospect for investors. NIO's growth in the Chinese EV market makes it a stock to consider. Moving on to Palantir, a company specializing in big data analytics. Palantir is a leader in its field with a competitive edge in predictive analytics and data-driven decision-making capabilities. This edge is reflected in its steady revenue growth over the years. Looking at the price history, Palantir's stock has seen some volatility, but the overall trend has been upward, indicating a growing investor confidence. The company's net income growth also tells a positive story, with year-on-year increases indicating strong financial health. In terms of profit margin, Palantir has been improving in recent years, showing its ability to generate profits from its operations. The company's debt-to-equity ratio is relatively low, suggesting a conservative approach to financing its growth. Lastly, let's talk about the price-to-earnings ratio. While it is high compared to the market average, it is justified by the company's unique position in the high-growth data analytics industry. Palantir's unique data analytics capabilities make it a stock with potential. Next, let's look at AMD, a major player in the semiconductor industry. Advanced Micro Devices, better known as AMD, has a competitive edge with its high-performance computing and graphics solutions. They've been going head-to-head with Intel and NVIDIA, carving out a significant market share for themselves. Their revenue trends have been impressive, with a consistent upward trajectory over the past 5 years. The stock price mirrors this growth, showing a steady climb that reflects investor confidence. As for net income growth, AMD has shown remarkable progress, turning around from a loss-making position to achieving substantial profitability. This has resulted in a healthy profit margin, indicative of the company's effective cost management. AMD's debt-to-equity ratio is relatively low, suggesting a sound financial position. The price-to-earnings ratio, while on the higher side, is justified by the company's growth prospects and earnings potential. AMD's strong performance in the semiconductor space makes it a stock worth considering. Finally, we have NVIDIA, a leader in the GPU market. This tech giant's competitive advantage lies in its innovative prowess and dominant position in the graphics processing unit industry. NVIDIA's GPUs are a critical component in modern computing, gaming, and increasingly artificial intelligence applications. Over the past few years, NVIDIA has shown an impressive revenue growth. The company's stock price has followed suit, reflecting the market's confidence in its prospects. Net income growth has been robust, demonstrating the company's ability to translate revenue into profit. Speaking of profits, NVIDIA's profit margin has remained healthy, indicating efficient operations and strong pricing power. The company's debt-to-equity ratio is relatively low, suggesting prudent financial management. NVIDIA's price-to-earnings ratio, while high compared to some competitors, reflects the market's expectation of future earnings growth. With its leadership in GPUs and growing presence in AI, NVIDIA is a stock with potential for future growth.